जनगण मन अधिनायक जय हे भारत भाग्य विधाता। पंजाब सिंध गुजरात मराठा द्राविड उत्कल बंगा। विंध्य हिमाचल यमुना गंगा उच्चल जलधि तरंगा। तव शुभ नामे जागे तव शुभ आशीष मांगे। गाहे तव जय गाथा जनगण मंगलदायक जय हे भारत भाग्य विधाता। जय हे जय हे जय हे जय 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 हे।
Thank you. Namaskar mitro. Speaker of this evening, learned Shri Dastur Sahib, Vice President Sunil, Joint Secretaries Manish and Abhay, and Treasurer Suhas on dais, galaxy of past presidents present today, family members of Shri Dastur, members and students from BCA present here, members who are connected with us through live streaming, ladies and gentlemen, a good evening to all of you. A warm welcome to each one of you to this annual pilgrim we all come to pay respect and hear the star of this lecture meeting. On 1st February, when Finance Minister Mr. Jaitley rose to present the Union Budget 2018, he faced three main challenges. Firstly, this was the budget for a pre-election year, and his government was not in the comfort zone that it was a couple of years ago. Secondly, there was widespread disillusionment with the benefits of demonetization, and the negative impact was percolating through the economy. Thirdly, GST, the game changer, was 7 months old, and all the stakeholders were still testing waters. In that backdrop, Mr. Jaitley achieved the balancing act. The FM stuck to fiscal prudence while accepting that the percentage prescribed were not sacrosanct. This budget lays significant emphasis on the agriculture sector and rural India. It is in these areas that the voter had shown its dissatisfaction and the ruling party was still licking its wounds. The finance minister seeks to address the concerns of the electorate in those areas. In terms of pure economics, it will possibly give fillip to a lagging sector of the economy and may generate employment. He has sought to give health coverage to 10 crore families. If medical cover of rupees 5 lakh per annum becomes reality, it will be the greatest achievement of his government and one of the biggest in the world. He has reintroduced the long-term capital gains tax on shares. This was expected and is a follow-up measure after the tax on dividends. However, in doing so, he has grandfathered the gains up to 31st of January 2018, which is in keeping with his promise that charging provisions should not be retrospective. There are various other provisions regarding direct taxes which seek to achieve a degree of rationalization. Like the budget, the address on the direct tax provision of the finance bill by Shri Dastur is an event that all professionals and businessmen mark in their diaries well in advance and show up in very large numbers on the lecture day. For 3 decades, we have heard his incisive analysis. I recall what a colleague of mine had mentioned, that an increment in the complications in law, BCA seems to have moved this budget lecture meeting from the proximity of a hospital to the proximity of a place where prayers are offered. Hearing Shri Dastur is like hearing the Guru in these holy premises. We all go away year on our year with the satisfaction that we have heard all there is to know on the direct tax law in the budget. Many of us consider his to be the last word on the subject. We are grateful to you, sir, for having given your deep insights to many generations of this profession. We wish to inform all present that Shri Dastur has been requesting us to excuse himself from addressing the members for the last few years. But sir continued to address us for the love and affection he has for BCAs and the profession. However, this year we have heeded to his request, though with a heavy heart. Today's will be Shri Dastur Sahib's last lecture and the 30th one addressed at the BCA platform. 3 decades is a long time in any organization's time span. We were fortunate enough during this period to avail of his masterly analysis year after year. We are sure that his association with the society will continue, maybe in a different role, for times to follow. As a mark of respect, we have made a small video of his years at the BCS. Can you please play the video, please? On this occasion, the office bearers, led by the Vice President Sunil Gabawala, we will felicitate Dastur Sahib. This is a portrait made by charcoal and pencil from a photograph of Shri Dastur Sahib. So the podium is all yours now, sir.
Mr. President, ladies and gentlemen, Mr. President, you have rendered me almost speechless. I say almost because you will still have to hear me. I thank you for your kind words, and I'm grateful that the BCA rules do not require the President, before he introduces a speaker, to take an oath that he will tell the truth and only the truth. So let's get on with the budget 2018, and let me make a few remarks which I think require consideration. The first amendment in the Income Tax Act is the definition of accumulated profits. And it is said that accumulated profits, in the case of an amalgamation, you will have to add to the profits of the amalgamated company the profits of the amalgamating company as on the date of amalgamation. Now you, as chartered accountants, would more readily work out the consequences of this proposal. Would not the profits of the amalgamating company be already reflected to some extent in the profits of the amalgamated company? If so, and you are still to add these profits to the amalgamated company, will it not result in an excessive assessment? Because to the extent of the accumulated profits, there would be a liability for payment of dividend. Now, the reason which is given is that people, by reducing their capital, avoid payment of tax under Section 222D, which deals with dividend on reduction of share capital. Now, assuming it is so, how does such a blanket provision can at all be justified? How can you add the entire profits of the amalgamating company to the amalgamated company's profits? And how long? There is no limitation. So for 30 years after the amalgamation, you will still keep on adding the profits of the amalgamating company to the profits of the amalgamated company, because there is no limitation. If what is stated as the reason, that is, people avoid tax under 222D, if that is so, I do not know, then you can use the provisions of GAR if you think that some unfair advantage is being taken. But how can you thrust such an amendment on all companies which have amalgamated? I think this requires careful consideration and perhaps redrafting, if not omission, of this provision. The next provision, which requires some comment, is compensation received by any person, by whatever name called, in connection with the termination or modification of the terms and conditions of any contract relating to his business, is to be assessed as profits and gains of business. So any profit received in respect of termination or modification of the terms becomes revenue receipt. Now this goes counter to all concepts of when is compensation to be regarded as a capital receipt and when it is to be regarded as a revenue receipt. if the compensation puts an end to a contract, then that is certainly not a revenue receipt, but a receipt on capital account. So therefore, to deem such and this is exactly laid down by several decisions, one of the latest being the decision in the case of Khanna and Anandhanam versus CIT, 351 ITR 110, where they held that a receipt for termination of a particular assignment would be a receipt on capital account. It follows that this compensation is also to be regarded as income, and it is to be regarded as income from other sources. Again, I think this sort of an amendment, as well as the next one that I will refer to, really shows how a distinction between a capital receipt and a revenue receipt is now being almost extinguished, because section 224 has been amended, which defines income innumerable number of times to tax as income what is not income under any concept of law. The other compensation of this type is where one receives compensation of a salaried employee, receives compensation on account of the alteration in the terms and conditions of his employment or on the termination of his employment. This is to be assessed as income from other sources. Now, it is overlooked that presently Section 17(3) Clause 1 provides that profit in lieu of salary is accountable as income. So we now have two provisions dealing with the same subject and providing that it is to be regarded as income. One is 17(3)(1 and the other is 56(2)(11). Obviously there is a conflict, and the person who drafted this amendment in 56(2)(11) was not conscious that there is already a provision in section 17(3)(1 to this effect. The next important item is conversion of an inventory or stock in trade to capital asset. Hitherto, this subject is not dealt with in the Act. Conversion of a capital asset into stock in trade is dealt with. It is stated that this will be regarded as a transfer under section 247, but capital gains tax will only be recovered when that asset is sold and not before that. Now, insofar as conversion of an inventory into a capital asset is concerned, it is provided that the fair market value of the inventory as on the date of conversion will be treated as profits and gains of business. So it would follow that not the entire value on fair market value on conversion is to be income, but obviously it is to be taken into account under the head profit and gains, and one will get deduction of the cost for acquiring that stock in trade. It is also provided that when this capital asset is sold, stock in trade converted to capital asset is sold, then the capital gain will be the sale price minus the fair market value of the inventory as on the date of conversion, because that difference has already been assessed. And furthermore, indexation is to be allowed only from the date of conversion, not from the date on which the stock in trade was acquired. It is also made clear that in determining what is a short-term capital gain, you will have regard to the holding from the date on which the conversion takes place. So after converting, if it is sold within 1 year, it will be regarded as a short-term capital asset. The next amendment of some consequence is the extension and widening of the scope of business connection under section 911. Presently, income from business connection is deemed to accrue in India if the business connection springs from an activity carried on by a non-resident through a person who has authority and habitually exercises authority in India to conclude contracts on behalf of the non-resident, unless such activities are confined to purchase of goods in India. That is the scope of business connection. Now, it is widened. Even if the person doesn't have such authority, but habitually concludes contracts on behalf of the non-resident, or even habitually plays a principal's role leading to the conclusion of contracts by the non-resident, it would be regarded as a business connection. So one looks at whether a person has habitually exercised this right, not whether he has the power to exercise that right or not. And provided, of course, the contracts are in the name of the non-resident, or for the transfer of ownership or goods or property belonging to the non-resident, or for the grant of the right to use property which the non-resident has the right to use. For example, if the non-resident has a tenancy in India and one gives the right to use that property to someone else, it may be regarded as giving a right to use property which the non-resident is possessed of. A contract for performance of services by the non-resident, even though the services are performed from outside India, is also taken into the scope of business connection. The exception that there would be no business connection where goods are purchased for export or to promote purchase in India is removed. So therefore now, even if goods are purchased in India for the non-resident, it may result in a business connection and a liability in the hands of the non-resident. Not only this, not only the action, but significance, economic presence of the non-resident in India now results in the non-resident having a business connection. What is meant by significance, economic presence? It is defined as including transactions in respect of goods, services or property carried out by the non-resident if the aggregate payment arising therefrom exceeds a limit which is to be prescribed. So that will be regarded as significance, presence of the non-resident. Further, the transaction in question would include provision of download of data or software in India. Significant economic presence also includes systematic and continuous soliciting of business or engaging in interaction with such number of users as through digital means as may be prescribed. How they will determine the number of persons who have been contacted through digital means, I don't know, but this is what is stated in the Act. And how it can be disputed that I did what? You will summon that person? I never contacted him. So therefore, I think persons who draft these amendments should also take into account the consequence and what it will result in. It is extremely vague and litigation prone, which is of course to the benefit of all of you and all lawyers. The first proviso says that a non-resident can have significant economic presence in India even though he does not have a residence or place of business in India. Obviously, if he has a place of business in India, he would have presence in India and would be chargeable. But this is what is provided. These amendments have been made, the reason which is given is important, to bring in line the provisions of the Act with the widening scope now prevailing under the double taxation avoidance agreements. As per BEPS Plan 7 and Multilateral Convention to implement tax treaty related measures. So you are trying to bring into the Act the provisions in the DTA which are against the SSC. Hitherto the philosophy has always been that the Act is paramount and the DTA is subsidiary. Section 90 subsection 2 brings that out, that nothing in the DTA which is contrary to the Act will apply. Now you are amending the Act to make it compliant with DTA requirements, overlooking that the DTA requirement may not apply if the other party, if the country of the other party has not accepted this. So therefore it may be you are introducing an amendment in the Act will affect the SSC, even though the DTA which you are following may not be applicable in this case, because the other party, say Mauritius or Singapore, has not accepted that amendment. So I think it's a bit topsy-turvy. What is paramount, the Act or the DTA? I would think it has to be the Act, and the DTA has to be trimmed to be in line with the Act, if at all, but not and give some concessions, but not the other way around. Tax greed knows no limits, and that is the only reason I can give for this. But tax greed, you sometimes overlook the consequence of greed is indigestion. So again, I think incorporating into the Act what is in the DTA and adverse to an SSC is not the best philosophy. Then another amendment which is introduced is percentage completion method has to be followed in construction contracts. You cannot say I will follow the completion method so that I presume the first 30 or 40% will not be regarded, but after you've completed 40%, one will be chargeable to tax. This may mean that you are chargeable to tax in years 1, 2 and 3, but if your expectations don't come true, in year 4 you may have a loss on the actual completion of the contract. This again prepones the time of charging the profit to tax. The same provision also applies in respect of service contracts. They have to be also on the basis of proportionate completion, but one exception is if the contract is not to last more than 90 days. But if it is to last for 91 days, you must apply the proportion completion method. Now, again it is for consideration whether by expediting the time of paying tax is much achieved, because in the overall limit you are not increasing the quantum of tax you will collect. The Bombay High Court has stated more than once that we don't see sense in provisions which impose a tax liability in year 1, which could as well have been accounted in year 3. But then, as I say, when you are in the 4th year of your government and are not really conscious as to whether you will be there after 5 years, you want to collect it as soon as possible. The The next piece of amendment is in section 1023C. Section 1023C grants exemption from tax in respect of certain funds, universities, hospitals, etc. The proviso lays down conditions to be fulfilled to avail of the exemption. For example, the prescribed portion of the income has to be applied for the purposes for which the fund is formed. Now it is provided that if a payment has been made in cash for achieving the objects of more than 10,000 on a day, that will not be regarded as an application. Similarly, if you have to determine whether the prescribed percentage has been made, this allows 30% of the sum paid to a resident if tax is not deducted at source. So therefore, say if a hospital or an educational institution pays to a doctor or to a teacher an amount without deducting tax at source, then that will not be regarded as application of income. But only 70% will be regarded as application of income. So if you've spent 100, only 70 will be regarded as application. And if you've not fulfilled the requirement of application, you may not get exemption under 1023C. Now what happens if the fund makes a payment to a doctor or to a teacher without deducting tax? Pays 100, only 70 will be regarded as application. Now as you are aware, if you omit to deduct tax at source, the revenue can demand that amount from you if the recipient has not paid that tax. So supposing the doctor does not pay tax and the revenue demands that amount from you, you will again have to pay it. And question will arise, will that payment be regarded as application for the purposes of the fund? Or will they say, no, this is not application for the purposes of your fund, this is to make good your default in not deducting tax at source. So therefore, even though ultimately you pay 70 today, you pay 100, don't deduct tax, only 70 will be regarded as application. If subsequently you pay over that 30, you will not get the benefit of application. Now this has to be thought through. That can you impose something like that? It's very good to say, just I'll collect more money. But you have to be realistic. You have to consider what are the other possibilities which may arise and whether it will cause unnecessary hardship to the assessee. Then it is provided that in the section that provisions of 41A and 43 will be applied mutatis mutandis. Now I think it would be much better if you specify exactly what you mean, because it is again very vague and may raise several issues which will have to be decided. The new provision speaks of provisions of 40 applying mutandis. It will be better now. An amendment similar to that for 1023C also applies in the case of exemptions claimed by a charitable trust, because under section 11, application for charitable purposes has to be at least 85% of the income unless you accumulate for future application following the prescribed procedures. Then an interesting point which arises in connection with the provision for Section 11 application. Section 80 of the Income Tax Act says that if you're a charitable trust, if you want to set off any capital loss in the future, you will have to file the return of income in time, and the loss will have to be determined. Now what happens? You file a return disclosing your professional income and a capital loss. The officer accepts your return, does not determine the loss. The section requires, Section 80, that the loss must be determined. Does it mean it is impliedly determined by not upsetting something in the return? Or do you then have to file an appeal, and the only ground being direct the officer to determine the loss? Or make an application of a mistake apparent from the record? So again here in 80, using the word determined, nobody has raised this issue up till now, but using the word determined may prevent an assessee from getting credit for losses which he has already incurred. Then we come to what they call a financial transaction. And it is stated that, this is important, every non-individual, every person other than an individual, who enters into a financial transaction exceeding 2.50 lakhs in a financial year has to apply for a PAN. Now a person may enter into a financial transaction exceeding 2.50 lakhs, but what will be taxable is only 30,000 or 40,000. But still, he has to apply for a PAN number. What is more, it is provided by the amendment that not only must the non-individual who has a financial transaction exceeding 2.50 lakhs, not only must that person apply for a PAN number, but any person, any director, any author, any settlor, any office bearer of that non-individual has also to apply for a PAN. What does that mean? If a company enters into a financial transaction exceeding 2.50 lakhs, does every director of the company have to apply for PAN, assuming he doesn't have a PAN at the moment? Every office bearer has to apply for PAN if he doesn't have a PAN at the moment. This is again not thought of as to whether every person or only a managing director or only one director. The purpose, this is in now 139A6, which casts this obligation on directors to apply, also speaks of that a trustee must apply. But, as you are aware, the High Court has Bombay had taken the view in Shardaben Trust versus CIT that, and 247 ITR 1, wherein they have followed the earlier decision in Marson's Beneficial Trust 188 ITR 224, to the effect that the status of a trust or a board of trustees is that of an individual, not association of persons, not body of individuals, but individual. That means that a trust is not within the scope of 139A5, which says that every non-individual has to apply. Now, if the trust is not within 139A5, how can you say the trustee of the trust must still apply for a PAN? So 139A6 is totally meaningless when you bear in mind that a trust will not be within the scope of 139A5. So again, this is a meaningless provision. The desire to make life difficult is understandable, though not appreciated. But it should be done in a legal manner. Just by providing you must apply for PAN, without there being no necessity to apply for PAN, does not stand to reason. Then I come to amendments with regard to 222 clause E, which treats as dividend any loan or advance made by a company to a shareholder who beneficially holds 10% of the share capital of the company. Up till now, such amount which was regarded as dividend was assessable in the hands of the recipient. And the company who advanced the loan did not have to pay DDT in respect of it. It had to pay DDT for all other dividend, but not this. Now, for some reason, it is provided that the individual will not have to pay tax on this amount, but the company must pay DDT on it at the rate of 30%. So even if you've advanced a loan of 5 lakhs, the company will have to pay tax at 30%. Leave aside equities about it. Now, as I said earlier, this provision would come into play if the loan is given to a person who holds 10% of the, beneficially holds 10% of the share capital of the closely held company. Now, Mr. A is a shareholder. B, C and D, who are also shareholders, are his binamidars. And assuming that is permitted under the Benami Act, it doesn't fall foul of it. Now, if A, B, C, D hold more than 10%, then the company will have to deduct tax from that. But how will the company know whether B, C and D are nominees of A? The company is to pay tax when a loan is given to a person who beneficially holds 10%. But how? There is no mechanism how the company will know that B, C, D are nominees. So the company would say, I am not at fault. How do I deduct tax if I don't know that A doesn't hold 10%, A holds 8%. But B, C and D, who are his nominees, hold 8% each. So in effect, he holds 32%. How will the company know whether it is a nominee? If the company doesn't know, because even declaration of under the Companies Act will not apply. So if the company doesn't know this, then you can't hold the company responsible. The individual shareholder will say, now I am no longer responsible for paying dividend, for paying tax on dividend under 222E. So you may end up with the situation where the individual is not liable and the company pleads correctly that there is no way in which I can implement this. So you cannot penalize me. Now, this again shows how provision is made for imposing liability and at 30% without having regard to the implementation of that provision. So this provision which is there, it is over-enthusiastic provision. The amendment has been made, and this is what the provision says. How do they justify it? In the explanatory memorandum, that it has been made to bring clarity and certainty. What is the clarity? In fact, you are introducing uncertainty. So what is the certainty that you are bringing? I mean, words are used to justify it being rational, it being to make it apparent, transparent, etc., etc. But words must have some meaning, and if they don't, and you don't adhere to that meaning, it makes no sense. Then 43A provides at the moment that when there is a foreign exchange fluctuation, then you will, if it is on capital account, adjust the written down value of the asset on which you will get depreciation. Now they've introduced 43AA to provide that if there is a fluctuation in foreign currency, then the difference will be on revenue account, always. So therefore, if there is a fluctuation in the foreign exchange currency, which results in a loss, it will benefit the assessee. If it results in a gain, he will be liable to tax. Then I come to what the President referred to about long-term capital gains and transfer of equity shares. Today, there is complete exemption in respect of shares sold on the stock exchange or units of a equity fund or units of a business fund, provided STT has been paid both at the time of purchase and at the time of sale, where the purchase takes place after October 2004, when the STT provision came into force. Therefore it is felt, I presume, that capital gain, assessees get undue advantage on account of the exemption from charge of capital gains. And it is said, even in the explanatory memorandum, that the reason for making these changes is that Section 1038 inherently biased against manufacturing and has encouraged diversion of investment in financial assets. What does that mean? Does it mean that today an individual who invests in financial assets will now go into manufacturing because he doesn't get this exemption? You may use word to justify that we are doing this very worthwhile thing, but does it make sense? And does the explanatory memorandum think? Probably members of parliament don't read explanatory memorandum, but does the framer think that anybody who reads it will not look at it rationally, whether it serves any purpose? It is better not to justify an assessee-unfriendly amendment rather than give such reasons, which do not really stand scrutiny. It is also stated that the exemption of capital gains has led to abusive use of tax arbitrage opportunities. Abusive use of tax arbitrage opportunities. Assuming it is correct, what have you framed GAR for? Apply GAR. If all that could come within GAR and you could challenge it is now made in the section itself, then where will GAR come into play? So if you think some unfair advantage has been taken and it is not according to what the intention is, apply GAR. But you don't have to make these amendments. then in certain circumstances, I do not know. I think you gentlemen and ladies are more adept at determining it, whether it would be advantageous for an assessee to claim application of section 112 as existing at the moment and which still continues, rather than to go under 112A. He may be better off by not selling on the stock exchange. I think that is feasible. If what I feel is right, then do you think that it may give rise now to people advertising that they will directly purchase shares at a rate which is given? So the person who wants to sell shares will get advantage of 112. The person who buys the share will buy it at lesser than the market price, so he will gain also. I do not know whether, now they have not yet said so, but they could perhaps have said that this will be the result and this will result in greater employment. Because greater employment is flouted all over the explanatory memorandum. But they have not said it, probably because they have not thought of it. Then, hitherto, as per section 80AC, deduction was not admissible under 6 provisions unless the return was filed in time. ATI-A, ATI-AB, ATI-B, ATI-C, etc., etc. Now it is stated that unless the return of income is filed within the time prescribed in 139(1), under chapter 6A part C, no deduction will be available. So if you want deduction under part C of section chapter 6A, you have to file the return of income in time. And part C covers sections 80H to 80TTA. So the requirement may now of clause 23 is to file the return. And now, presently, the provision applies only for 6 types. Now for the entire provisions, the return has to be filed in time and there is no exception permitted. An individual has fallen sick and he could not file the return in time. He will not get carry forward. He will not get a certain deduction he is entitled to. Should there not be some provision for unforeseen contingencies to be taken into account? They say that equity and tax are strangers. But do they have to be enemies? Then I come to 271J. It provides for imposition of penalty on an accountant, a merchant banker, or a registered valuer who has furnished incorrect information in a report or certificate. A penalty of 10,000 per default can be charged. Now, penalty is charged by either the assessing officer or the commissioner. It is provided that by amending section 253 that where the penalty is charged by the commissioner, an appeal will lie to the tribunal. But there is no provision where the penalty is charged by the assessing officer, an appeal will lie to the commissioner. So if the assessing officer imposes this penalty on an accountant, he has no recourse. But if the commissioner imposes it, he can file an appeal to the tribunal. Again, I say total irrationality. Then one comes to another, all these are provisions adverse to the assessee. Then there are certain provisions, you may be surprised, are also in favor of the assessee. For example, a salaried employee gets a flat deduction of 40,000. Flat deduction was done away with from the assessment year 65-66. At that time, it was provided that, done away with 2006-7, sorry. At that time, it was provided that the flat deduction will be 30,000. Now it is 40,000. But everything is not chocolates and sweets. Simultaneously, it is provided that the exemption up to 15,000, which is available, where the employer meets the reimburses medical cost to the employee, will no longer be available. Further, the benefit of conveyance allowance or transport allowance, which today is 19,200 per year, will also not be available. So though you get a flat deduction of 40,000, you are at the same time deprived of deduction of 15,000 and 19,200, which means, if my mathematics is correct, that you get an advantage only of 5,800. Now in the speech, it is emphasized, look, we have done so much for the employee. But what about this hidden cost which is there, which the employee has to bear? Then deduction is allowable for mark-to-market or other expected loss computed in accordance with the income computation and disclosure standards. I, for my part, am at a loss to understand how you can compute this according to these standards, and also say not only mark-to-market but any other expected loss. Now, how can you show this is an expected loss? I should get deduction. And supposing the expected loss does not fructify, what happens? Now, under the Act today, the stamp duty value has to be taken in certain circumstances. For example, under section 50C, if a capital asset is transferred, but the fair market value as per the stamp duty authorities exceeds the fair market value disclosed, then the stamp duty amount will be regarded as the fair market value and capital gain computed accordingly. Similarly, under 43CA, which is inserted in the assessment year 14-15, where there is a transfer of land or building or both, which are held as stock in trade, and there is this differential between the stamp duty value and the value disclosed, again the stamp duty value will be taken. Further, under 56(2)(10), which was inserted last year, stamp duty value is to be substituted in the hands of a recipient when he receives property from another person. And if that difference between the value is disclosed and the stamp duty value will be taken. Now, it is provided that one will take the stamp duty value, which is also known as the circle rate value, only if a play of 5% is not satisfied. Therefore, if you show consideration of 100, but the stamp duty value is not more than 105, it will not be applied. It is for consideration whether just a 5% adjustment with the stamp duty value is sufficient. But what you have really to think is that when this stamp duty value was made compulsory, did not the finance minister think that you can't have such a provision? Because there may be several reasons why the stamp duty value in an area may not be comparable to the property you are dealing with. Because stamp duty in an area is on a uniform basis. Your building may be dilapidated. Stamp duty value will be the same. You can appeal to the stamp duty authorities, but should not in income tax a larger play be allowed? And why was in the first place provision introduced without any play? Then there are various provisions for exemption from payment of capital gains tax if an investment is made in certain specified assets. 54 and 54F deal with the case of sale of residential accommodation. That has not been disturbed. But other provisions are no longer applicable, that is 54A, 54E, 54EA, 54EB, 54ED, because they all dealt with certain transactions before a particular date which is now elapsed. So the only two provisions now which are applicable are 54EC and 54EE. 54EC provides for investment of the capital gain in bonds redeemable after 3 years, not earlier, which are issued by the National Highway Authority or the Rural Electrification Corporation. 54EC will apply from assessment year 2019-20 only in respect of capital gain arising from transfer of long-term capital assets, being land or buildings or both. That is not for gains from the transfer of any other asset. And further, that investment is to be in the bonds is to be redeemable after 5 years. So the 3-year period is now extended to 5 years. Section 54EE is interesting. It was inserted last year and provides for exemption from tax on all long-term gains where investment is made in units issued before 1419 by notified funds. I have not been able to find any funds having been notified as such up till now. So therefore, 54EE, though more than a year has elapsed from its introduction, is still a non-starter. Further, both in 54EC and EE, investment has to be made within 6 months of the transfer. And you cannot get exemption for more than 50 lakhs invested. So if you invest 60 lakhs, the exemption will be confined only to 50 lakhs. This is dubbed in the explanatory memorandum, and also capital gain from transfer of only land and buildings. Now these amendments have been dubbed as rationalization. What does one mean by rationalization? There is a section which you have not made effective, and there is another section in which you have imposed certain further terms. What is rationalization in that? I understand that therefore now, if nothing is prescribed under 54EE by 1/4/2019, which is just about 14 months away, 54EE will be a dead letter for all time to come. Then, under section 79, if there is a change in shareholding, you do not get the benefit of carry forward. This is now amended to provide that if the change in the shareholding is on account of a plan framed under the bankruptcy code, whereby there would be a change in shareholding, that will not affect the right of carry forward. A new era in tax rates has now come into being. Its seeds were sown in 2017. I refer to the rate of 25%, which will be applicable to the predominant percentage of companies, where the turnover does not exceed 250 crores. If the turnover exceeds 250 crores, then tax will be payable at 30%. Apparently, only 7,000 companies have turnover in excess of 25 crores, and this is a very small percentage of the total number of companies registered. Now, if I may just go back and give you some budget takeaways. If one is asked how one would classify this budget, my response would be that it is an income tax officer's budget. It will enable the officer to do all the things he wanted to, but did not have authority to do. There is no real wide underlying scheme. And I'm reminded of what a member of parliament of long standing, who had seen various budgets presented by different political parties, said. He said, "This reminds me of pins in a government office. Some amendments are made with heads, but no points. Some have points, but no heads. And there are several which neither have heads nor points." This is perhaps too drastic an assessment of budgets, but this is what it is. The present budget indicates that the framer, if he wants to do something, he will go ahead and do it and give reasons for doing so, being rationalization, creating transparency, accountancy, increasing employment, and furthering public interest. But do any of these reasons really make sense in any particular case? It is interesting to find that in the Income Tax Act, from section 80A to 80VV, which would normally mean 23 sections, one actually has existing 54 sections, because section 80 is followed by an alphabet of the English language. And because the English language has only 26 alphabets, you will find section 80 followed by 4 alphabets, maybe A, D, E, F. So therefore, it really becomes difficult to keep track. And sections 80 to 80VV cover 150 pages in the Act. So you will understand how it would be difficult for a person to collate the section, and particularly if you are arguing a matter and you refer to, say, section DGA, for the judge to be able to trace 80 DGA will take quite some time, because it is not 80, 81, 82, 83. Not only with regard to sections, but you will find this also with regard to chapters. chapter 12, before you come to chapter 13, has 16 alphabetical numbered chapters. So chapter 12, then 16 chapters, and then chapter 13. Therefore, obviously, there has to be some rationalization. Then just to take you back a little in history. Before 1867, the accounting year was May to April. From 1867, it has been April to March. I do not know whether from 2019-20 it will be the calendar year, because there is a lot of talk of having it on the calendar year. Up till 98-99, the budget was always presented at 5 p.m. The reason was that this suited people in England to watch the budget at a rational time of 11:30 in the morning. Finance Minister Sinha did away with this, and from 99-2000 the budget was at 11 a.m. When he was asked why he did it, he said, so that I can go to bed early, which is not possible if the budget is presented at 5 p.m. Another change which has taken place is that the railway budget is no longer separately presented from last year, but is a part of the general budget. And the last statistic I would like to give you is that, as per my understanding, the figures have not been audited. Mr. Jaitley's budget speech in 2014 covered 16,536 words, and that is said to be the longest budget speech. In 2018, he has cut down his verbosity to 11,987 from 16,000. And then just one aspect of the tax law. It is said that no one can properly understand any part of a statute till he has read it through the whole again and again. How many agains it is not stated, because I don't think anyone can put a maximum number on that. Interestingly, recently, in Karan Diwan Hills Private Limited versus Assistant Commissioner of Income Tax, 400 ITR 43, at page 50, the Kerala High Court said, Income Tax Act is one enactment that can shatter anybody's linguistic confidence or competence. Even provisions, inevitably though, run into pages, subordinate, super-subordinate, subordinate, and sub-subordinate clauses, clipping the general meaning. With annual addition, the provisions lose coherence and defy comprehension. Neither a lawyer nor a judge can claim with comfort, if not with confidence, that he could comprehend the provision at least on a rereading. The taxpayer is surely lost in a maze of meandering phrases. It is therefore time for the revenue to host on the website a plain English version of the Income Tax Act. Before I come to the end, I would like to draw your attention to one amendment, and that is in section 143(3). It is stated that the central government may frame a scheme to make assessments under 143(3) for, please hold your breath, eliminating interface between the assessee and the assessing officer so as to impart greater efficiency, transparency, and accountability, optimizing utilization of resources through economies of scale and functional specialization, introducing team-based assessment. I don't know what team-based assessment means. One officer will assess your capital gain, another officer will assess your income from other sources. With dynamic jurisdictional scheme and by notification made direct that provisions of the Act shall not apply or will apply with prescribed modifications, additions as specified to be in rules to be placed before Parliament. So therefore, by rules, you can overcome whatever is the provision in the Act. Is that constitutional? And what is meant by team-based assessment? What is meant by dynamic jurisdiction? It is a good example of what Thomas Shadwell observed 400 years ago. Words may be false and full of art. If you don't want to go back that long, then you may quote Eliza Doolittle in My Fair Lady, where she chants, words, 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 I am sick of words. It is considered that eliminating face-to-face reaction with the officer is something good. But it only means that you have no confidence in your officers, because you think face-to-face means corruption. But what about the honest assessee who wants to put forward his claim to an assessing officer across the table? There are several things you cannot explain in writing. You may point out to him, look at this, what I have done, how do you assess this? Which you cannot do when you write. Now further, he makes an assessment, this all-knowing CPU, Central Processing Unit, and you find some objection. They are supposed to give you notice. You file an objection. Who will it go before? Because there is a team of assessing officers. If you are objecting to capital gains, it will go to Mr. Naik. If you are objecting to income from other sources, it may go to Mr. Patel. I don't know. Further, what does he write? Because he is supposed to peruse your response. I have seen cases where the officer, in rejecting your response, says, he repeats what he had initially done and said, I have considered your response, if any. Because the section says, he will consider the response, if any. So if he is not sure that I have filed a response, how is he going to consider it? As I say, this is frustrating. One wants to pay tax honestly, but doesn't want to be cheated. Then, Clause 6 of the proviso to 143.1 today says that in making an intimation, an addition cannot now be made under 143.1 for additional income appearing in Form 26AS, Form 16 or Form 16A. Does it mean that he cannot make an intimation, but he can make an assessment invoking this? Now in the real problem with regard to these magical forms is that you must have experienced, credit is not allowed for tax deducted, admittedly deducted at source. Because the form filed by the payer, who is the officer's agent, not mine. He is deducting tax as the agent of the officer, not as my agent. The form filed does not reveal so much tax deducted at source. But there will be several reasons why this is so. He may treat it as income of year 1, but the assessee treats it as year 2, or the other way around. Then this action is contrary to decisions of all the high courts, including the Bombay High Court, in Yashpal Saini versus Rekha Hajar-Nevis, 293 ITR 539, as well as decisions of the Gujarat, Assam, Karnataka High Courts, which are to the effect that once tax is deducted at source, the person from whose income tax is deducted does not have to do anything further, and the revenue has to give him credit for the tax which is deducted. The CPU, in not granting proper credit, acts not only contrary to these decisions, contrary to the provisions of section 205, but also contrary to circulars which the board has itself issued, and the board takes no action in the matter. You issue a circular to satisfy a person that, look, I've issued this. But do you implement it? Also, the Delhi High Court has laid down certain rules in 352 ITR 273. These are also flouted. And what remedy do you have? Now what is proposed is something incomprehensible and unimaginable. One reads reports that your assessing officer may be in a state other than yourself. So you are in Bombay, the assessing officer may be in Guwahati. So even if you want to go and see him, you will not be able to do so. And what is the consequence? Because the jurisdiction of the commissioner is determined on the basis of the jurisdiction of the officer. So you will have to file an appeal to a commissioner in Guwahati. And how will you go and argue before him? So therefore, I think this is frightening, that your assessing officer can be thousands of miles away from you. And this is supposed to be to avoid the interface. But then why don't we do this? We should provide that cabinet ministers will not meet anybody. After all, meeting between the minister and a businessman may be the source of corruption. So why not eliminate all these meetings? Just as meeting with an officer may lead to corruption, where actually you go for a particular business. The businessman may go to meet the minister for no business other than some personal aggrandizement. So this transparency, whatever be the merit, I am too old to understand the relevance of this. And if at all there is merit in it, please first get your house in order. Let the CPU function in a reasonable, tax-efficient, equitable manner. After you have done that, you may think of all these highfalutin things. But if you do it today, the honest assessee will also say, no, there's no sense in being honest if this is the difficulties I have to establish what is my right. Without attending to these fundamental shortcomings, the grandiose schemes to me appear to be of no relevance. And it is for the finance minister strictly to consider the hardships which the assessee faces and try and administer to them and not enhance them. Mr. President, you were kind enough to say several things. 30 runs on a sticky budget wicket is good enough. Perhaps I have overstayed and ought to have exited earlier, as some friends of mine suggested, citing the example of people like Pete Sampras and Rahul Dravid. But then my feeble answer was, don't compare me to giants. How can I follow the example of giants? I thank God that it did not dawn on the BCA Managing Committee to have a replacement. I have enjoyed the 30 sessions and thank all of you who have been attending the meetings out of a somewhat ununderstandable sense of friendship. My particular thanks, and I repeat, particular thanks to all my juniors, past and present, for their unstinted, diligent and loyal contribution to the subject matter of these meetings. I once again gratefully thank all of you as I take my leave. Thank you.
Friends, we are happy to inform you that the popularity of Shri Dastur Sahib is all across the country and the globe. Today, more than 8,000 people have viewed this telecast live, including people in the US, Europe, Singapore, and 13 other countries. Also, people have tweeted online during the lecture. I thank each one of them who have viewed today's lecture online. As usual, today also Sir has delivered a masterly analysis of the direct tax provision of the budget in his amicable style along with lot of anecdotes. The finance minister may have introduced a tax on long-term capital gain, but Sri Dastur Sahib's learnings to us over 30 years do not attract any tax, and they are lifelong for all of us. With this, may I request Treasurer Suhas to propose a vote of thanks.
Good evening, all seniors and friends who are present here as well as those who are on the e-platform. It is my proud privilege to present our gratitude and our vote of thanks to Shri Dastur Sahib for his contribution year after years. Sahib, you are a giant in yourself and need not be compared to anyone in your own field. Sahib, today is an event which is a part of a journey of last 30 years, long 30 years. One of my OBs said at that point of time, we may be in the college. 30 years of a lucid and commanding analysis of the budget provisions. 30 years of sharing and sharing of knowledge, expertise and experience gratuitously and wholeheartedly. 30 years of inspiring people throughout. I could term this as a budget yatra, an annual pilgrimage, which everyone awaited to take a deep dive into the ocean of knowledge spread by you, Sahib. This is one of the most sought after event of BCAS and most populated and most popular because of your presence, sir, and because of your analysis. I, on behalf of all of us here, pray for your well-being for the years ahead. And now I request all of you once again to offer our gratitude and our vote of thanks with a loud applause and standing ovation. Thank you very much, sir, from the bottom of our hearts. Just I request all the past presidents to be on the dais for photograph with Mr. Dastur. Thank you very much.